Hello there and welcome to another casual educational video. This one is all about Piotroski's F-score. The gentleman here on this photo is the person responsible for its existence. He published a research paper a little bit over 2 decades ago, and in that paper he elaborates on basically the reasoning behind this F-score, the way he created it, as well as shows some information that this score beats the market for a period of over 2 decades. So we're going to take a look at how the score is created, whether it still works today or not. And I want to point out that this description that's coming from Wikipedia is not fully correct, especially this second sentence that the score is used by financial investors in order to find the best value stocks. And even Piotroski himself didn't claim that that is the case. The title of his research paper is actually how to use the score to differentiate or to separate the winners from the losers. However, as we're going to see, it wasn't used for all companies out there, but for a subset. So let's take a look at how it all started. Piotroski wanted to create a score that could be used to create an investment strategy that is based on the fundamentals of the companies that have high book to market value. Now, already here, we have a subset of all the companies that are out there. So he's only focused on the companies that have high book to market value. What is that? Well, if we swap these two, the market value is price and the book value is something that we see from the accounting statements. So he's only looking into companies that have low price to book ratio. Now, what is common for these companies is that they're most likely financially distressed. They're at a position that they could go bankrupt, they could recover, nobody knows, but they're a bit more struggling than the average company on the market, and therefore they're selling close to their liquidation value. Now, his reasoning was that these companies are less followed by analysts as they're not that interesting. There's not a lot of interest from the investors, and oftentimes there's no forecast available or stock recommendation, of course, because just nobody is going to pay too much attention to even analyze them and after that to buy them. So this is how it all started. So the F-score is created by backtesting on particularly these companies. Therefore, if we are to use it for all companies out there, it would not be correct. It was not designed for that purpose. What Piotroski came up with, and of course every research paper, it starts with a lot of indicators, for example for this one, and eventually it gets down to a smaller number of them. So at the end he got to 9 binary signals that can either be good or bad, and he had divided those into 3 groups. So depending on how many of these indicators are present for a particular company, this score would be between 0 and 9. 0 means that the company doesn't fit, or the score of 0 means that the company is performing quite poorly based on these 9 indicators, and is more likely to have a worse future compared to a company that has a score of 9. And the purpose of this score is kind of to answer the question, is this particularly financially distressed company going to recover? Is it moving into the right direction, or should we lower our expectations about that? So let's start by looking into the first set of signals, the profitability related ones. Here he has 4 signals. So the first one, does the company have positive return on assets? Basically, is the company profitable? If the answer is yes, that's already 1 score for the company. Number 2, does it generate positive cash from operations? If the answer is yes, there's the second point. And this is basically, it's kind of a checklist and it goes through all 9 indicators are equally important based on the score. And again, it ranges between 0 and 9. The third one is there a positive change in the return on assets compared to the year before? And if the answer is yes, again, it means that the company has improved its return compared to the year before, and therefore it's again moving in the right direction. And the last one is the cash from operations greater than the net profit? So not only if the company is profitable, but does that profitability translate into having cash? And we could sum up all this into one simple question. Is this company profitable enough and bringing enough cash to survive? So these are the indicators that based on the back testing became it became clear that are significant from a statistical point of view, so statistically significant, and should be taken into account when analyzing these, again, financially distressed companies. So if we are to use these indicators for the mature companies, it's not going to be as useful because a lot of these will just be there, will be present. A lot of companies that are mature and not struggling are profitable. They make money. The cash from operation is greater than the net profit. So it's not that relevant for these companies that are in a good position financial wise. Now, the second bucket is leverage, liquidity, and source of funds. And here there are three indicators. The first one is decrease of long-term debt. Of course, if we think about it from a financial point of view, if we have increase in long-term debt of a company that's already struggling, that's not a good signal. However, if there's a decrease, that should be treated as a good signal. The second one is increase in current ratio. And here we could argue that, of course, if the change is a percent, maybe it's not that significant. So it's not perfectly designed. So if a company has decrease of current ratio by 0.1, it would not get a point. However, if it increased by the 0.1, it gets a point. So it doesn't take into account the change. It's only a binary. So either this indicator is present and the criteria is met or not. And the third one, and I think this is also quite interesting to see, it definitely has a logic behind it, equal or decreasing shares outstanding. And this is important because if this third indicator was not part of this group, basically any company could have issued more shares and in return get cash, which would increase the current ratio, and they could use part of that cash to pay the long-term debt. And from that point of view, the first two indicators would have been checked, right, on the checklist. However, the shareholders would have been diluted and we would not have seen it here. So by adding this third indicator, of course, we take care that if that is the case, if they issued shares to decrease the debt or to increase the current ratio, that at least they get a negative point or no points for the number of shares outstanding. And the last one is all about the operating efficiency. And it's comparing the company's performance this year against the previous year. Is there increase in gross margin, whether that's by decreasing the cost of their products or increasing the sales price? In any case, if there's an increase, it shows that the company is doing better than it did the year before. Increase in asset turnover is kind of comparable. However, it really focuses on the actual revenue because it's a ratio between the revenue that the company brings in and the asset base. So is the company making more or bringing more revenue with the same assets, or as a ratio, did the ratio increase over time? Now, if we put ourselves in the shoes of Joseph Piotroski, we have identified the companies that have low price to book ratio, and then we have calculated all of these different indicators, right? For every single company, we have a score between 0 and 9. Now, then we need to align on how do we calculate the returns, because at the end, if we want to see if it beats the market, we need to compare the returns of these companies against the market. And this is his explanation, or the way that he calculated the returns. He says, I measure firm-specific returns as 1 year or 2 year, because he ran multiple experiments at the same time, buy and hold returns earned from the beginning of the 5th month after the firm's fiscal year and through the earliest subsequent date, 1 year or 2 years after return. And compounding began over the last day. So that's not that important. The first part is the 5th month. What does that mean? If you have a company that has a fiscal year starting from January and ending December, of course, once the annual report is out, you could calculate all of these ratios and calculate the so-called F-score. And then the 5th month, beginning of the 5th month, so in May, that is when he starts calculating how good the company will perform for the next 12 months. So starting from 1st of May until 30th of April. And we could argue, why 5th month? And his explanation is, I chose the 5th month to ensure that the necessary annual financial information is available to investors at the time of portfolio formation. So what he's trying to do is he selects a period, not month 4, not month 6, month 5. It can also be argued that it's arbitrary and that this information would have been available much earlier than that. However, all research papers are to some extent slicing and dicing data until you get something that's statistically significant. Now, this is the outcome that he got. And if you take a look at this here, this is the outcome of a 1-year market adjusted returns. So N, the number of companies that were analyzed, 14,000. Out of these 14,000, you can see the distribution based on their F-score. So 57 companies had a score of 0. So not profitable, not bringing cash from operations, increasing debt over time. So all of these information that we saw, increasing shares and so on. 333 had a score of 9. And of course, we have the companies in between. And what he's trying to prove is that on average, the ones that had a score of 0 underperformed the market by 6.1% in a year. The ones that had a score of 9 had 16% performance better than the market. So if the market performed, let's say, 4%, then this 16% over that is 20% return. Again, these are market adjusted returns. And it looks impressive. But if you take a look at the structure, the 10% worst performing companies that had a score of 0 lost 71% more compared to the market. So if the market did, 10%, right, then they did minus 61%. The worst 10% in the companies that had a score of 9, again, that fit all of these criteria, underperformed the market by 45%. And if we take a look at the median, which is if we put all the companies next to one another and we sort them based on the return, the market adjusted return, the one that's in the middle with a score of 0 underperformed the market by 10%, and the one with a score of 9 underperformed again the market by 1.2%. And the percentage of companies that performed better than the market, as you can see, 38%, 30%, 37%, 37%, 40%. So roughly 50% in let's say if we take a look at the ones with high F-score, outperformed the market, with roughly 50% underperformed. However, when there's a performance better than the market, that percentage was much higher. So the best 90%, as you can see, that 76%, 49, 73, 66, 89% better than the market. So it's quite clear that because he's looking at financially distressed companies, the range of outcome is very wide. And running these experiments, of course, something pops out as statistically significant, and at some point you end up with something that looks like this and looks impressive. But how can one use this to build a strategy? Well, it's a little bit more difficult because the only thing you can do is buy all of these 14,000 companies. If you take a look at any of these scores, you'll notice that the best and worst performing companies, you would not want to hold the worst ones and you would want to hold the best ones. It's not that it separates the winners from the losers per score. Of course, the ones with a score of 9 did better, but if you bought the one that had a score of 9 and it performed minus 46% compared to the market, you wouldn't be happy, right? So the F-score on its own cannot show us which company out of these 333 to buy. It can increase the probability, but it doesn't pinpoint the one that is actually a good stock pick. And he also did this exercise, and I know that you can't see the bottom right part of the chart, of the table, but I'll try to explain the idea behind this. He divided all companies into two groups. The first group is the ones that have a strong F-score, where the score is greater than 5, and the ones that have a weak F-score or a score below 5. And he calculated the returns for all of these companies per year. As you can see, in 1976, he had 383 companies 1977, 517. And what he tried to prove is that the companies that have strong F-score do better than the ones with low F-score or weak F-score. And he calculated here the difference between the two. And as you can see, only in a couple of years, only the weak F-score performed better than the companies with strong F-score. So it's quite clear that the score on average provides some information, but again, it doesn't pinpoint which one is the one that will do best with 60 or 70%. Now, recently there were some more backtestings done, and as you can see, this is one that is for 2006 until 2020. So not as long period as what Piotroski had here between 76 and 1996. It's a little bit over 2 decades. This one is a little bit less in terms of the time. And the blue line is Piotroski's, the return based on Piotroski's F-score. And as you can see, it's a lot more volatile compared to the S&P 500. And it's not consistent, right? It's something that we, of course, could expect. And it really depends on the market conditions and whether these companies that are more in a more difficult financial position perform better or not. Now, it's quite clear that if one wants to use this, it has to buy a lot of companies, or once the companies with a high F-score are identified, still needs to do more research. So keep that in mind, and anytime that you see somebody using the F-score, first of all, ask yourself, is it being used on a company that is financially distressed? Because if the answer is no, then the score doesn't have that much relevance. Of course, a lot of the indicators on their own are useful. However, the score for majority of the S&P 500 companies would be, for example, quite strong, over 5 or 6. So we can't really make a decision solely based on the score. Now, my personal thoughts on this is, first of all, every single research paper involves a level of cherry picking, slicing, and dicing the data in order to get something that's statistically significant. Now, what Piotroski did was, first, he chose a subset of all the companies. He only focused on the ones with low price to book ratio. Then he chose a period between 1976 and 1996. Now, he could have chosen a period before 1976, but didn't for some probably there isn't a good reason. However, he had to choose a certain period, and probably this is a period that worked well to prove that the F-score works. But why did he stop at 1996? That's also a little bit of a question mark. The paper is published in the 2000s, so at least 2-3 years more of data was available, and he could have done some backtesting. Again, it could be that in the last years, the outcome would not have been as impressive as for particularly this period of 2 decades. Maybe not, but it's again a question mark. And the third decision that he made was to start counting or measuring the return the 5th month after the financial year end. We can argue that the investors have the same information 4 months after as well. Now, he chose 5th month, he could have chosen 6th month. Again, all of these different variables that he chose on purpose lead to certain outcome. So the outcome would not have been the same if he chose a different part of the market, so a different subset of companies, if he chose a different period, and if he chose a different starting point to measure the returns. Personally, I don't see how I would implement the score to select a company. It's not something that fits my strategy as well. But it might be a good idea to avoid low F-score companies. And what does that mean? Well, if a company is not profitable, doesn't bring money, the debt increases year over year, they keep issuing more shares, right? The gross margin is decreasing. They're not making enough new products compared to the year before. So, I mean, these are very logical questions to ask ourselves when we are analyzing a company. So it's an interesting approach that he developed to take all of these important factors into account. But for me personally, I stick to the quote that if there's something that sounds too good to be true, it is most likely too good to be true. So for me, I don't see a way to implement it in my analysis as a score. I do understand that, again, for the purpose of writing a research paper, it's an interesting discovery, but implementing it, yeah, it's probably one of the only ways to really use it is to buy 10, 12, 15,000 companies in a period of 2 decades, which I have no intentions personally of doing. That would be all regarding this video. Please let me know if you have any questions or comments, and I'll see you in the next one.